Welcome to our weekly webinar. This week we have financial literacy and higher education. I'm just going to start off with a few hellos and welcomes from everyone who's on the team this morning. So I'm Sophia, I am the pre-16 manager. I've also got the Wonder team who are from Money Talks, Naomi and Daryl on the line. Would you like to say a quick hello?
Hi, good morning everyone. Looking forward to working with you this morning.
Great morning.
Fantastic. And we've also got Sean. Sean, would you like to say a quick hello?
Hi everyone, I'm Sean. I also work for the University of East London and I'm going to be your moderator. So I'll be in the chat room today answering any questions.
Okay, great. So thank you everyone for introducing yourselves. And just a little bit about the University of East London. So we were established in 1898. You can see in the bottom right hand corner there, the oldest part of our campus down in Stratford. We actually have two Stratford campuses. And then we also have one campus, which is our main campus in Docklands, which you'll see is the group of white buildings there. It's actually huge. And that picture doesn't really do it justice, but just to give you an idea of what it looks like. We have students from over 135 different countries. However, we do have a large contingent of students from the East London area and London and the areas surrounding London as well. So the aims of today's session, we hope by the end of it, you'll understand basic financial management. You'll understand the difference between being a financially savvy and financially unaware. Able to manage your money better if and when you go to university, and to understand how student finance works at a basic level. Okay, so I'm going to hand over to Daryl and Naomi for the Money Talks part of the talk this morning.
Thank you so much, Sophia. Guys, welcome. Hope you guys are ready for today. Hope you've got your notepads and pens and ready to take notes. You're going to learn some things today. All right, so I'm going to tell you a bit about myself. As Sophia said, my name's Naomi. I am a multiple business owner. I have 5 different businesses, and I'll tell you a little bit about those as we go through. But do you know what? This is actually my favourite business. Daryl, do you want to know why this is my favourite business?
I think I know why. No, I think it's because you get to work with me.
Yeah, great. Yeah, I do get to work with you. But do you know what? More importantly, for me, I get the opportunity to share what I've learned about money and finance, about wealth, really about how money works. I get to share that with young people. And with Money Talks Education, we work with schools and colleges and universities, really teaching young people about what we know about money and finance. And I absolutely love that. Tell us about yourself, Daryl.
So great morning, everyone. It's lovely to be here with you today. My name is Daryl Harper, and I have been teaching financial education now for 12 years. Our background was in teaching in a school, but teaching something completely different. I was actually in a college teaching media, filmmaking, video production, but the last 12 years of my life has been dedicated to empowering young people and adults to understand how money works, run my own business, which has been fantastic. And this is actually one of my favorite events. You know why, Naomi?
Why, Daryl?
Because I get to work with you.
Well, fantastic. Thank you. I'm pleased that we like working with each other. So, you know what? One of the things that we're going to talk about is the difference between being financially savvy and financially unaware. Okay, so really thinking about, guys, from a student perspective, being a financially savvy student and a financially unaware student. And Daryl and I have worked in universities across London and up and down the country, and we see this all the time. What do you think the difference is between being financially savvy and financially unaware? So let's get some answers in. Sean, if you could let us know what comes in. But in the meantime, Sophia, what would you say? What do you think the difference is between being a financially savvy student and someone who's financially unaware?
I think having a grip of what your outgoings are and your incomings are would be a good place to start, and doing a bit of research in terms of maybe like the bank accounts that are available to you as a student, I would say. So I know I did a bit of that when I was like, I'm not going to go for the one that gives me a free iPod back then, but you know, I'm going to go for the one that maybe I get a better rate on an ISA, for example. Back then, again, those are a slightly different situation now.
Yeah, definitely. It's So what are some of the answers that we've got coming in, Sean? What do the young people on the webinar today think that the difference between being financially savvy and financially unaware?
Yeah, so we're just getting some answers in now. And she says she thinks being financially savvy as a student is not just relying on your overdraft and getting into lots of debt as soon as you sort of start your first term of university.
Excellent, excellent. That's a great answer. We've seen students that have gone into their overdraft in the first term of the first year at university. No, that's just not going to do well. It's not going to bode well for the rest of the course.
You know what's interesting? I was doing an event for some young people, and there was a 16-year-old who was already in debt and was already in his overdraft at 16, hadn't even gone to college yet, was still in secondary school.
Oh, wow. So we've got one comment here, which I think is really insightful. So somebody who's remained anonymous has said that they think the difference is that one student will save more of their money or put more of their money into relative pots, whereas the other will spend it as soon as they have the money.
I like that. Daryl, what do you think about that one?
I feel like when this person grows up, they should come and work with us. They sound like they know exactly. I feel like we should turn the presentation over to them.
Over to them, right? All right, Daryl, I'm going to hand over to you to talk us through.
So I think one of the things that's really important about being a financially savvy student is understanding the difference between smart debt and bad debt, because there is a difference between the two. And if I had to summarize it, I'd say smart debt is something that it grows in value or creates a level of income, some sort of income. And a bad debt is when you purchase something and it quickly loses value. Yeah, so debt is when you're essentially borrowing money, but it depends on what you're borrowing it for. So for example, Naomi, let's see what you know, Naomi. So let's say, for example, you're at university. There's going to be a university party, and you want to get a new outfit that you can post yourself on Instagram, because you can't be seen in the same outfit that you previously wore, right? So you get a new outfit and you pay for it with your credit card. Is that a smart debt or a bad debt, Naomi?
Okay, so you know what I'm going to say? I'm going to say that's a bad debt, Daryl, because as much as I might look good in the outfit, there's no value to it. It's not going to make me any money, and there's no value. Once I've bought the clothes, that's it. I've spent the money. So I'm going to say that's an example of bad debt.
I'm going to give you a 10 out of 10 for that.
Thank
All right,
you.
I've got one more for you. Going to university.
Yeah.
Smart debt or bad debt?
That one is an easy one. For me, that is an example of smart debt. And I think it also explains the difference between investment and expense. And guys, it's really important that you understand the difference between what an investment is and what an expense is. And with an investment, you don't always see the returns immediately, right? And that's like going to university. I've got 2 degrees, and you don't always see the returns immediately, but it pays out in the longer term. And I know Sophia's going to talk a little bit about, how much that can benefit you. But definitely going to university, I would say, is a smart debt. Yeah.
I'll give you a 10 out of 10, Naomi. Well done. And one of the things that I learned growing up as a child, one of the sayings that was always said to me is, if you can't afford it, then do not buy it. So I think once you understand the difference between smart debt and bad debt, I think it's also important to understand, well, what's the APR, and what does APR actually stand for? So what APR stands for is the annual percentage rate. So what that means is, when you borrow money from the bank, for example, they will charge you for borrowing that money, for the privilege of borrowing that money. So essentially, it's the price you pay for borrowing money. Yeah. So I think it's important to understand the debt trap.
Yeah. So guys, let's imagine that you have £3,000 on a credit card, okay? And the interest on that credit card is 20.77%. So that's the APR, as Daryl was saying. That's the money that you're being charged for having that £3,000. So every month when you have a credit card, the bank requires you to pay at least something back, and that's called the minimum payment. Okay, so every month you pay off the minimum payment on that £3,000 credit card, and you don't make any new purchases, so you only have the £3,000 to pay off.
So the question is, how long will it take for you to pay off that loan? So we're going to ask you guys to put the answers in the chat box. So A, 19 years and 10 months. B, 54 years and 7 months. Or C, 130 years. So post it in the chat box. A, 19 years and 10 months. B, 54 years and 7 months. Or C, 130 years.
Oh, Sean, what would you say on that one, just as a guess?
Oh, it's a tricky one. I think it would probably take really quite a long time to pay that off. So without sort of doing the quick maths in my head, I think it would take at least 50 years, I'd have thought, although I'm not entirely sure. But I think it would take really quite a while to get rid of that debt, unfortunately.
Sophia, what would you guess?
You know, it's really tricky because you're like, okay, well, it's a minimum payment, right? So everything that you are in a debt for, there's interest being added to it. And I think people forget that. But I couldn't even figure out the maths again. Like, just to sit down and work that out would be like, I'm hoping there's something out there on Google that would work that out for me. It's hard. It's really hard. But I don't know. I think it's only £3,000 at the end of the day. So maybe A.
So go with A. Perfect. And what answers have we come back from the young kings and queens?
So we've got an answer here. She's agreeing with Sophia, saying A. We've got a couple of people saying kind of a mix between A and B, saying B. Seems like most people are saying they think it's B. So people seem to think it's around 54 years.
So here comes the big reveal. The answer is B, 54 years and 7 months. Here's the question, Sophia. How old are you going to be in 54 years and 7 months?
You don't have to answer that.
God, like, I'll be ancient. I don't know if I'll even be alive by that point, in all honesty, at my age now. So yeah, long time.
So imagine if you're 14 years old, that means you're still going to be now obviously you won't have a credit card at that point, but if you're 14 years old, you're going to be 68 years old before you even got a chance to pay that off. So here's the other one. How much interest will you pay? A, £3,254, B, £10,009, or C, £23,506.
This is the part that people don't think about, is the interest and how much APR is added on top of the debt. So what kind of answers have we got in the chat box so far, Sean?
Yeah, so they're just coming in. C, somebody who's anonymous saying C as well. So it seems like people are sort of thinking it's going to be quite a lot of interest.
Here comes a big reveal again. You'll be happy to know it's a little bit less than C, but it's still a lot. £10,000, over £10,000 you pay. So imagine that you only borrowed, Naomi, £3,000 for your night out to post your pictures on Instagram. It's going to cost you, but you're going to be paying for that outfit that probably doesn't fit you anymore 54 years later, or you don't look good in anymore, and I'm sure you will. But that outfit didn't cost you £3,000, it actually cost you over £10,000.
That's a joke. That's a joke. So do you mean to tell me that if I borrow £3,000 on the credit card, I'm actually paying back $10,000?
100%, Naomi.
How
do you feel about that outfit now?
Pass. Let's move on.
How do you feel about that Instagram photo now?
Let's move on.
So it's so important that you understand, and that's why I made that statement at the beginning. If you can't afford it, don't pay for it. And credit cards are not, I want you to also understand, credit cards are not necessarily bad. It's about how you use the credit cards. Yeah, it's about how you use it. And that's what we're going to talk about now, when we talk about the importance of understanding your credit score. Well, actually, it's not just the importance, it's about understanding the importance and the benefit of having an excellent credit score. So what is a credit score? So a credit score is something that shows a lender your worthiness of borrowing money. So i.e., if you've got an excellent credit score, When you go to borrow money, i.e. for maybe getting a mortgage or getting a car on finance, you get better rates of return. So you pay less APR, you pay less interest. However, if your credit score is poor or bad, then they're going to charge you more money for borrowing money. So the better your credit score, the better interest rates you get. Your credit score is bad or poor, you get a worse interest rate. So they want to understand or want to see how responsible you are in being able to borrow money and actually pay it back.
So Darryl, what type of things can you do to kind of make sure that you've got a good credit score and you can be building up a good credit score?
So that's a fantastic question. So what kind of things could you be doing to make sure you build a credit score? And I encourage you all to write these down. And there's going to be a lot more. One of them is maybe even having a mobile phone on contract in your name. Just your ability to pay that bill on time helps to improve your credit score. Being on the electoral roll, so making sure that you're on the electoral register helps to boost your credit score. If you do borrow money, paying it back on a timely manner. So it's not about getting into loads of debt. It's about, you could have £10 on the credit card, then you pay it off the next month before they charge you any interest. Then you put then £10 again, and you pay it off again the next month before you pay any interest. So anything like that, Naomi. Okay. Bills that you pay on time, being on the electoral roll, paying off your credit cards quickly. One of the things that doesn't help is if you do loads of credit checks. For example, if you keep borrowing money or taking out a loan here and another credit card here and another loan there, all of those things negatively impact your credit score.
All right, so this as well is something else that we've seen financially savvy students do compared to students who are financially unaware. And financially savvy students will always have a budget and a plan for their money. Now, the important thing to note about a budget is it's not about the amount of money, okay? It's about the skill of being able to budget the amount that you have. And guys, if you can start having good budgeting skills from now, then this will carry you through university and throughout the whole of your life, okay? So if I give you £10 and you don't know what to do with that £10, or you don't know how to budget that £10, if I then give you £100 or you get £100,000, you're going to do exactly the same thing as you did with the £10. So remember, it's about the skill of knowing how to budget the money, not necessarily the amount of money that you have. Okay, Darryl, over to you.
So I think, when you're financially unaware, what you tend to do sometimes is you tend to, as you see in the picture, you tend to just burn money. You're not aware of where you're spending it. You may not even have a respect for money. And money for me is very much like people. If you don't respect people, they tend not to stay around. And money is the same. If you don't respect money, it tends to just to leave you. So you spend money on things that you don't necessarily need. You buy things on emotion. You get excited and you want to buy that new purchase that you see advertised on Instagram, YouTube, on TV. And you just have no conscious idea of what you're doing with your money and where you're spending it and how you're spending your money. So it's important when you're financially savvy to have at least 3 accounts, And the first account I'd encourage every single one of you to have is what we call your emergency fund. So in the chat box, I want you to just quickly write down, what do you think an emergency fund is used for?
I like your little picture, Darryl, with the raining man. It's raining money down on the financially savvy student. This person's budgeting, they're doing their thing, they're getting money raining down on them.
Yeah, do you know what? And that's gonna allude to what an emergency fund is for. And I don't want to say it. I want to see what these young geniuses come back with. But that is funny. That's what it's like. The difference is when you're financially savvy, you don't have an umbrella. You have a bag trying to catch the money.
Yeah.
It's trying to shield yourself away from it.
Yeah. So what kind of answers are we getting coming in so far, Sean?
Yeah, so they're just starting to come through now. We've got an answer here saying she thinks that it's something that happens unexpectedly.
Yeah.
Which, I completely agree with. An answer here, and she's saying she thinks it's sort of like a safety net, Something perhaps for last resort, again, sort of something unexpected.
Yeah, I like the word safety net. That sounds good. So Daryl.
That is fantastic answers, and you're both exactly right. They have a saying, you always have to have money set aside for a rainy day. So those are for the things that happen that are unexpected, or you just weren't expecting. That could be something like what's happening a lot now with a lot of adults now is they're being furloughed, where their hours of work have been cut and reduced, which also reduces their income. It could be later on in life things like redundancy, or you've got this car and you need the tires blow out in the car, or the boiler breaks down in your home. You need to have some money just in case the rainy day comes. And one of the biggest challenges for those of you, and this is probably all of us that have lived in the UK long enough, it rains quite frequently in the UK. So you quite often need a rainy day fund. Now, when you're financially unaware though, what happens is you don't have a rainy day fund. You don't have money set aside just in case. And you then sometimes feel that you're forced to use a credit card or a loan when that emergency hits. When that emergency comes, you turn straight to the credit card. But you never need to do that when you've got a safety net, as someone said. And that safety net, the amount of money that you should have in your emergency fund, should be the equivalent of at least 6 months worth of your monthly income. So whatever you get paid on a monthly basis, that should be what you have. Over 6 months worth of what you get paid on a monthly basis is what should be in your emergency fund. So even if you get pocket money, and let's say your pocket money's, I don't know, £50 a month. I've never really got paid £50 a month for pocket money, to be fair. Some of you get spot. But £50 a month pocket money, 50 times 6 is going to be £250 that you should have in your emergency fund. Yeah, no, £300 you should have in your emergency fund. Yeah, perfect. So short-term savings, Naomi.
So yeah, out of the 3 accounts, so you've got one account which is for your emergency fund. Your second account is for your short-term savings. Okay, so if you guys are writing this down, 3 accounts. The first one is emergency, the second one is short-term, and things that you're going to be saving for in the short term are things like your holidays. So a financially savvy student is going to have money set aside for their holidays, whereas Daryl,
what I'm going to do, Naomi, is I'm going to pay for my holiday on credit card. And there's a lot of people that pay for things on a credit card, but I'm not going to be able to pay off the credit card the next month. I would have come back from the holiday, and a year later, I'm still paying for the tan that has left my body, Naomi.
oh dear. So things like my driving lessons, I'm going to be saving up for my driving lessons. I'm going to be saving up for buying that car that I'm going to get when I pass my license. What are you going to be doing, Daryl?
Well, Naomi, I'm going to surpass you. What I'm going to do is I'm going to have a chauffeur, and my chauffeur is called TFL. I'm going to be traveling on the train and the bus for the rest of my life, and that's okay if you don't want to ever drive. But if you do want to drive, then the TFL is your chauffeur.
And do you know what? Things like insurances. So when you go to uni, sometimes you've got to pay for your contents insurance, your car insurance. If you pay it off in one go, if you pay it off annually, it costs you less. So I'm going to be that financially savvy student that is paying for things in the one time rather than yourself, Daryl. What are you going to be doing?
Yeah, see, Naomi, I don't want to pay for everything in one go. I mean, that's quite painful. I think what I'm going to do is I'm going to pay for it on a monthly basis. But the challenge with me paying for it on a monthly basis is what, Naomi?
Well, you're going to end up paying more because you're paying, when you pay monthly, you pay more.
Yeah, so I wish I was more financially savvy like you. So we've got the emergency fund. We've got the short-term savings for things like the holidays, your driving license, a new car, paying for insurances. And the other account you need to have, your third account, should be for your long-term investments. So your long-term investments. So any goal that you have in your life that is more than 5 years away should be going into long-term investments. Ideally 10, but at least 5 years away. So some of the things that, if I was financially savvy, Naomi, I'll be saving up for things like additional education. I may want to save up for things like a master's degree or a PhD in some sort. However, Naomi, what you're going to do is what?
Well, I'm going to because I'm not going to have that kind of money, I'm going to take the first job that comes just because I need an income, and actually not because I've got the choice, because I've got some money behind me. So typically what we find is a lot of students, when they come out of uni, they just have to take the first job that they can find. They're financially unaware. They haven't thought that long term. They haven't planned for that long term ahead.
You know, the other thing I'm going to do now is I'm going to start saving towards my first home. Yeah, I want to get on a property ladder. I want to be a homeowner. So I'm going to start saving for that from now. What are you going to do, Naomi?
Well, I'm going to pay someone else's mortgage. So I'm going to end up probably paying rent because I haven't thought about the long term. Again, guys, we want to get you thinking about the long term from now. It's never too early to start thinking about these type of investments. A university is an investment, like we spoke about earlier.
So what you're saying, Naomi, is because you are financially unaware, you're going to pay rent and probably pay more than I would pay for a mortgage.
Yeah, that's probably.
And you're never going to own a home, but I will.
All right.
I'm just saying, Naomi. First important to be financially savvy.
It is important.
You might actually pay the rent for the house that I rent to you.
Okay, let's keep it moving.
Also, though, because I'm financially savvy, you know, the other thing I'm going to do, I may even think about starting my own business one day and start saving towards my startup. Where what you may do if you're financially unaware is.
Yeah, do you know? I think sometimes when you don't know your own value, what happens in life is that you kind of get stuck in a rut, and you never know how to ask for more money when you go to your boss and know really what you're worth in terms of the salary. So we find a lot of people get stuck trying to climb up the corporate ladder because they haven't thought about how much, you know, in terms of a financial perspective, how much they're worth to the company.
Because I understood my value, I started my own business and decided what I was going to get paid on a daily basis. And you know the other thing, Naomi, even though I'm quite young, I know that these things are likely to happen. So I'm going to start thinking about future planning. I know I'm not just going to be thinking about today and right now. I'm going to be thinking about what about when I get married one day and I want to pay for a wedding or children or having a comfortable retirement and retiring at the age that I want, with the lifestyle I want, with the income I want. But because you are financially unaware, Naomi, what did you do?
Yeah, I did the opposite. Let's move on. Let's just move on. But guys, you get the point. That's the third account you need to have. You need to have 3 accounts: your emergency funds, you need to have your short-term savings, and then you really need to be thinking about your long-term investments. That doesn't need to start right now if you're 14 years old, but we're sowing the seeds so that you get the skills and you have an understanding of what to do going forward.
Yeah, and can I just add one more thing to it, just to help the young people out? If you get into the right habits and you adopt this principle, take 10% of your income and put that into your emergency fund on a monthly basis. Take 5% of your income and you put that into your short-term savings, and then take another 10% and you use that for your long-term investments. That will be the strategy, irrespective of your income, that you should adopt and follow for the rest of your life. At least do that. I wish I knew these things when I was younger. So, Naomi, let's talk about understanding some very simple financial concepts and principles. And this is definitely one that I learned later on in life, but I wish someone would have taught me before. And it's something called the rule of 72. And what this does, it's an old banking principle. And what it does, it approximates how long it takes for your money to double or your debt to double at a given interest rate. So it means it can work for you or it can work against you. And if it's not working for you, it's working against you. So let's say, you know, you're a financially savvy student and you've got £10,000 saved in your bank account and you're getting 3% return on your money. I'm going to ask you guys to all guess in the chat box, how long do you think it will take for your £10,000? So how many years do you think it will take for your £10,000 to turn into £20,000 at 3% return? So how long before 10,000 turns into 20,000 at 3% return? So have a quick guess. How many years do you think it will take? I'll give you a clue. The answer is on the side where it says number of years.
Sophia, I know you like a good maths quiz. What would you say? So if you had 10%? £10,000 and you were getting 3%, how many years would you say?
Yeah, I'm trying to look at this and kind of work out in my head. So like what, 3%, 1% of 10,000, I'm trying to figure it out. And what, we're talking about £300 is 3% over so many years. But then that gets added to the main amount of money, so then that will go up a bit. Got a long time, 50 years. I don't know.
You're stuck around this 50-year guess mark. So
yeah, I don't know. It just seems like 3% is like really. I mean, we get nothing now, but 3% is still low, and if it's going to double, it's going to take a long time.
Yeah. Okay. So you're saying 50 years plus. Sean, what are you guessing?
Yeah, I'd say really quite a long time as well. Maybe sort of at least 40 years, I'd say. We've got everything ranging from about 72 years, 12 years, 48 years, 24 years. So people have really sort of chosen lots of different answers here. I'd say it's really kind of spread across the different numbers.
Interesting.
So here comes the reveal. For everyone that said 72 years, I want you to know you're not right. But everyone that said 24 years, you are absolutely right. It takes 24 years for your money to double. How you work that out? And don't worry, I didn't know this the first time I asked when I was asked this question. Is 3 goes into 72, 24 times, so 72 divided by 3. And then what happens is your money doubles in 24-year cycle. So after 48 years, you've got £40,000. Now just think to yourself, does that excite you? Some of you might think, yes, it does. But let's think about it like this. If you had £1 sitting in the bank, it means it's going to take 24 years for your £1 to turn into £2. 24 years later, you got £4. Or 24 years for 10p to turn into 20p. You can't even buy crisps for 20p anymore. 48 years later, you still can't afford a pack of crisps. So it's too long to wait for that amount of money. So let's say we double the rate of return and say, yeah, we want to get 6% on our money. You might think, okay, if we double this to 6 at the top, we're going to get £80,000 at the bottom. But see, money doesn't work like this. And that's why it's so important to understand in your maths class the power of compound interest. So what happens now, at 6%, your money doubles every 12 years. So 12, 24, 36, 48. So we've doubled at the top, but you've actually got your money's quadrupled at the bottom. Now, here's a fantastic one. Let's say you got 12% return on your money. Here's the question. You got £10,000 at 12%. How long, I want you to guess, how much money do you think you'll have after 48 years? So you've got 12% return. After 48 years, how much money do you think you're going to have? Have a guess in the page. Have a guess in the chat box.
Some of you are going to be thinking, I wish I paid more attention in my maths class now.
I wish I knew my 12 times table.
Let's see what kind of things are coming in. I remember the first time I saw this. It was really quite amazing. The rule of 72, and it is something that you can Google, right, Daryl?
Yep, you can Google this. You can find out more, understand the power of compound interest 100%. So do we have any answers?
We've got a couple of people just coming back saying that they're not sure. We've got Monica here. She's saying £120,000. Hetty, 160,000. Someone anonymous here saying 256,000. So again, a bit of a mix, I'd say.
That's kind of where I think I was when I guessed the first time. But Naomi, what's the answer?
So, guys, it's £2.56 million. £2.56 million after 48 years. Because that is the power of compound interest working for you. But Daryl, do you want to explain what happens? What happens with this rule?
Yeah, so this is like when you're financially savvy, you get this rule working for you, and you get better returns on your money. But I want you to also understand how the banks get this principle to work for them and against you. So let's say very quickly you borrow £10,000 from the bank, and you pay them back on a credit card at 12% return. That's the APR. 6 years later, you pay the bank £20,000 in interest, but you still owe them the 10. 12 years later, you're paying £40,000 in interest, but you still owe them 10. So you can imagine what's going to happen, and you can see what's going to happen after 48 years. So what the bank does essentially is they take the money that you're saving at 3% return, and they lend your money to other people on credit cards and loans at 12% return, and the bank will make all of this money from your money, give you back £40,000 to say thank you, but none of that money was theirs in the first place, but they keep the difference. So what the bank's really doing is getting your money working harder for them than they do for you. So when you're financially savvy, you understand this principle, but not only do you understand the principle, you get the principle to work for you and not against you.
So we've learned something today. We've been schooled today on the rule of 72. Thank you. Daryl, what's the next slide?
So we're just going to open it up for some questions now, because I want you all to understand this is 12 years of experience. And actually, Naomi, how long have you been teaching financial education now?
About 5 now, about 5 years.
So between us, there's 17 years of experience teaching financial education, and we can't take 17 years and wrap it into 30 minutes. So we just gave you a little bit just to kind of entice you and to get you excited about learning about money and principles and concepts. And then obviously there's more stuff out there for you to learn.
So one of the best questions that I think when we did a workshop there, I don't know if you remember, but one of the best questions that came in from a young person was, I think she was about 18, and she said, what would we have done, or what advice would we have for her at 18? If we could go back in time and we were 18. Do you remember that?
I remember that, and I actually remember my answer too.
Why don't you say what your answers? I remember my answer too.
I said I would have thought bigger, I would have acted faster, and I would have made a conscious decision to retire at 25 years old. So I would have thought bigger. I would have expanded my thinking. I would have understood that the world was my oyster, and I wouldn't have limited myself to what was available to me. I would have acted faster, so I wouldn't have procrastinated or delayed in taking action. I would have just taken action, done all the right things that I knew that were going to help me and my family, and I would have made a conscious decision to retire at 25. I would have still worked, but I would have positioned myself where I could comfortably retire at the age of 25.
Yeah, that's a great answer.
You remember what you said?
Yeah, I do. I said that I would have read more. I would have read more in the earlier stages. I read a book a week now, but if I was back then, I would have read more. I would have read things like The Richest Man in Babylon. I would have read Rich Dad, Poor Dad. All of those books to really get me understanding the importance of investment. And I think, like I've said before, I loved going to uni, and I loved the investment that it gave me, and it's really helped me later on in life. But yeah, I would have definitely read more when I was younger. Sian, any other questions coming in?
Yeah, so we've got quite a few coming in now. Is it necessary to have a credit card, or can you just have a debit card?
Very good question. So it depends. So for example, you cannot get a mortgage unless you've had some sort of debt at some point, and you've paid it off. So if you're thinking about getting on the property ladder, what some people do is they take a credit card just to build their credit score. But it's important that you only use the credit card and buy purchases when you know you've got the money in the account to pay off the credit card the next month. So people use it just to help build their credit score, or they have things like, as I said, a mobile phone contract in their name. But if you're never thinking about getting a home or having to borrow money, then you're fine with a debit card. But credit cards are what a lot of people use just to help build a credit rating.
So maybe we should take one more, and then we can get the questions answered in the survey.
Yeah, absolutely. So I'll try and combine two questions. What books would you recommend? So I can try and post them in the chat box as well, if you let me know some names. And also, someone says they're a bit confused about the rule of 72. So I don't know if there's any sort of further reading anyone can do that you'd recommend.
Yeah, that sounds good. That sounds good. I'm going to throw out a few of my favourite books on the topic. So the first one is The Richest Man in Babylon. That is a fantastic kind of book that teaches you about financial education. So that's The Richest Man in Babylon. Another really good book, as I said, is Rich Dad, Poor Dad. That's by Robert Kiyosaki. That's spelled K-I-Saki. So that's Rich Dad, Poor Dad and The Richest Man in Babylon. Daryl, what would you say your sort of favourite book? Well, I know what your favourite book is.
My one of my favourite ones is How to Win Friends and Influence People by Dale Carnegie. So How to Win Friends and Influence People. One of my other favourite ones is Outwitting the Devil.
Yeah, that's a good one. That talks about planning for the future financially, doesn't it? That one.
Yeah.
And then I think another classic would be Think and Grow Rich. So Think and Grow Rich by Napoleon Hill. So we've got The Richest Man in Babylon. We've got Rich Dad, Poor Dad. We've got How to Win Friends and Influence People and Think and Grow Rich.
I'm going to throw one more in there, just because the person asked about the rule of 72, the compound effect.
Yeah, that's a good one.
Okay, guys, I'm going to ask that we move on because it's 11:45 already. So we're going to just whip through the last few slides, if that's okay. Brilliant. So I'm going to talk a little bit about student finance very, very quickly. So just to talk about student finance at a very basic level, when you go to university, there is a fee attached to going to university. Currently, the fee stands at about £9,250 a year. Okay, it's a lot of money, and not many people can afford to pay that on an annual basis. Okay, for the 3 years of your degree. So the government, through the Student Finance England company, provide you with a loan. Okay, so that's one form of debt to pay for your tuition fees. So that's money that goes directly to the university. You don't see that at all, and it's just to pay for your fees. And then the second branch of that loan is a maintenance loan, and that's to help with your living costs. Okay, so if we go to the next slide, please. So you don't have to pay your tuition fees up front. That's the important thing to bear in mind. And you only pay back your tuition fee loans once you are working and your income is over a certain payment threshold. So if I could just go to the next slide quickly, please, Daryl. So the maintenance loan is dependent on your circumstances and how much your parental income is, or the income that you have through carers or anything else, whatever your home situation is. So if you live at home, you get less money, because the idea is that either your parents or your carers are supporting you, and you don't need to just fund yourself completely. If you're living away from home but outside London, that goes up a bit. If you're living away from home but in London, because living in London is expensive, that goes up a little bit more. Okay, so, and they, as I say, look at your parental income as well, just to, if your parents earn more money, then the expectation is that your parents will help you out a bit more, and therefore you won't get as much cash. So if I could go to the next slide, thank you. So you do not have to make any repayments until your income is over the payment threshold, as I mentioned before. So once you earn over basically £26,500 a year, then you start repaying only 9% back of your income. Okay, 9% is not a lot of what you would get over 26.5k a year. It's very manageable debt. It doesn't go against your credit score at all. And if you, for instance, fall out of work or whatever reason, the repayments stop. Whereas with something like a credit card or a mortgage payment to pay for your house, for example, those payments do not stop. Okay, but if your student loan repayment does. Okay, and any outstanding balance will be cancelled after 30 years of entering repayment. So those of you who end up being very high earners, it's 9%, so you will pay back more. Do you see what I mean? Because it's a percentage of your income, and you might not hit that 30-year threshold at all. But those of you who are on a lower income, say you go into other professions that you don't earn so much, so nursing, for example, is one. You know, people go into it because they care for people, not necessarily for the salary, and so they tend to get paid less. They may not have to pay after 30 years, but it depends how far up the ladder you go and how much more you end up earning, basically. So, quick question to everybody. On average, how much more money does a graduate earn in comparison to a non-graduate over their lifetime? So just to clarify, a graduate is somebody who has a university degree. A non-graduate is somebody who decided to go straight into work and didn't get a university degree. So how much more do you think somebody who has a degree earns over somebody who doesn't have a degree? Daryl, what do you think?
I reckon somewhere between maybe 60 to 80k.
Okay, 60 to 80k more.
Yeah.
More than a non-graduate over their lifetime.
Yeah, maybe.
So the difference, yeah.
Yeah,
Okay.
so I'll go in the middle, 70k.
70k. That's good. I like that commitment there. How about yourself, Naomi? What would you say?
Do you know, I don't know if it's as much as that, you know. I don't know if, yeah, I don't know if going to uni is gonna make that much more of a difference. But yeah, I'd be keen to hear what the answer is, Sophia. Let's see what some of the chat comes back with.
Yeah, so Sean, if you could give me a couple of guesses if they're in.
Yeah, so we're thinking it's about 20k, 50k, 30k. So again, a bit of a mix there.
So the answer is, guys, drum roll, £100,000 on average. That is the difference between being a graduate and a non-graduate, and that does vary in terms of the industry that you go into, obviously. However, it's worth bearing in mind. So yes, university does cost a lot of money, but equally it's an investment. So on investments you get a return, and that means you get a higher salary. And if you have a master's degree, you actually get more money. So bear that in mind too. Okay, so just a little taste of some of the scholarships and bursaries that are also available to you. I've just given you a little snippet, but if you go on our website, you can see the full range there. So we have the Vice Chancellor's Scholarship, which is almost £28,000 over the duration of your course over 3 years. So that basically pays for your fees. And then the Dean's Scholarship there. And then also we have some bursaries. So if you have particular circumstances, you can apply for bursaries, and these will be different for every different university. So at UEL, we have a Care Leaver and FOIA bursary. So you get 1,500 annually, and an engagement bursary. So basically, if you're involved in the community and you can prove it, you can get a bit of additional money there to help with your studies. So if we could go to the next slide. Thank you. So we're pretty much almost at the end of our webinar today. Sorry, I've whipped through that really quickly, but you should now know at the end of this, you should now have a basic understanding of financial management. You should understand the difference between being financially savvy and financially unaware. You should be able to manage your money better if and when you go to university. And finally, you now know the basics of student finance and who you need to apply to and how that works in general. So this is the end of our webinar. Thank you so much for listening. We hope you found it really, really valuable. I know I did. We're here every week, 10 AM on a Thursday. So look us up. And before we sign off, we can take a couple more questions. But in case I don't get the chance to say thank you so much to Daryl and Naomi for a tremendous webinar today, because I think it was really, really great and informative. And a big thank you to Sean as well. Sean, do we have any final questions from anyone?
Yeah, we had some questions earlier that we just didn't quite get the chance to get round to, so I'll just get those up again.
So thank you so much, Sophia, from Money Talks Education, and from our behalf, we really enjoyed this morning, right, Daryl?
100%. Thank you so much. I wish someone would have invested the time and had someone come and teach us this stuff, even though it was just a small amount of information we shared. It's the small things that end up turning into big results when you adopt them. So Sophia, Sean, thank you so much. Also want to say thank you to my business partner, Naomi Collette. Always outstanding, also always amazing.
So we got a question here, and she's saying, do student loans help with your credit score?
They don't help with your credit score.
So they don't, any debt that you have that's linked to student finance in England it doesn't affect your credit score at all, for good or bad.
No, not at all.
Great, thanks, that's good to know.
Okay, wonderful. Thank you guys, and thank you. Good morning to everyone. Have a great day. Take care. Bye bye.
Okay.